I note the previous chairperson said 11. Yeah, you're the previous chairperson. The previous chairperson misinformed the audience. We'll start right away.
Oh.
Ajay Shah, you know the rules of the game, right?
Thank you very much for inviting me, and I know that this is the last session, but the fact, it is the last session, right? It's not? Yeah, okay. Even then, I mean, I was not even on the program, right? So for me, this is huge. I'm really thankful that I'm getting to present this paper. It's order exposure in high frequency markets, and this is co-authored with Terry Hendershot, Samarpan Non, and Roberto Pascual. And if you look at the locations where they are, Roberto is right now actually doing a visiting in New Zealand. So you can just imagine the coordination challenges of getting all 4 co-authors to have a Skype call. So it's been a challenge, but it's been fun doing this work. So what we are doing here is looking at how traders choose to expose or not expose their order flow in modern high frequency markets. So just to set the stage, there's been a recent growth in non-displayed orders. So I know this is a law and finance conference, so just to set the stage, you send your orders to the market, to the limit order book markets, and then the orders at that, the best bid and ask cancel against or trade against each other, and you have trades, and those trade statistics are released at the end of every day. And in many data sets, you have them, real-time data. Now, obviously, the volume of orders that are sent to the market are way more than the trades that are executed. And generally, the volume of orders that are sent to the market, you can actually see them on the limit order book, unless a trader specifies that they don't want their order size to be displayed, in which case they check the non-display option, and you won't see the order. It's just a dark order sitting in the book. Now, I will talk a little bit about the different mechanisms by which different markets allow these dark orders to go in. But the volume of dark orders in markets have been rising over time. So if you think about the lit exchanges like the NYSE, NASDAQ, BATS, and so on, they allow dark orders within the lit exchanges. They are around 20–25% now, and another 10% comes from the dark pools that Yesha was talking about in yesterday's presentations. So overall, if you look at the US markets, it's getting close to 40% of the trades that are actually executed, reported, are trading against non-displayed orders. So there's an issue of transparency, pre-trade transparency in US markets. More interestingly, if you know the layout of the limit order book, this darkness is actually happening when and where it matters most. For example, if you look at low volatility days, you see these lines, and here is the best ask and the best bid. So for the non-microstructure people, quick explanation is this is where the trades happen. The best bid and the best ask, they meet each other and trades happen. So you see the darkness is actually spiking up at the best bid and ask. This is, by the way, from some proprietary data from NASDAQ. If you look at the crisis week when Lehman Brothers went down in the middle of 2008, you will find that there's almost 50% of the sell volume where sell happens is hidden. So there's traders that are trying quickly to liquidate their positions, but they don't want others to see that they're putting their orders in the book, so they're hiding them. In high volatility days in general, you see greater use of hidden orders. So the averages are actually masking even more a little bit of how important they are because of where they're placed, where they're most relevant. So now there have been some papers which look at the rationale for hiding. So theory gives us some evidence on order exposure, and these theories are conditioned mainly on the information set of traders. So if you look at uninformed traders, the old models like Copeland, Galai sort of flavor, what they said is when you are an uninformed trader, you don't have much information, but let's say you're trying to trade a big position. You don't want to place a 10,000 share order in the limit order book displayed and everyone can see that you're trying to get this big trade. So what you do is you place these large orders towards the back of the book as a hidden order, hidden liquidity, and you patiently sit around and if somebody should, if the price should move your way, you will get the trade then. And there is empirical support for this coming from, we have a co-author of the most preeminent paper in this, Kumar's paper. So they actually find this and they use Euronext data from 2003 to test, and they indeed find support for these theories. Now, more recently, we have a class of models which are talking about the information set. What about if you are an informed trader? Would there be some reason for you to use these hidden orders? So Sophie has a paper, Sophie Moynes and Bulatov and George, they are saying that sometimes even informed traders may use hidden orders to limit the leakage of the information of their orders. And there's the very recent work looking at experimental markets saying that there may be some truth to this. Now the reason why it's experimental support and not direct support is because the data on this, to do this kind of study is absolutely not available in US markets. To be able to identify who's placing an order, whether you're an HFT or, do you have information or not, requires detailed data. Now, when we looked in the literature, like Kumar's paper and so on, we saw that the evidence on the use of order exposure comes mainly, in all of it, if I'm not mistaken, all of it comes from pre-high frequency trading market. Markets in recent times have this big group of high frequency traders and they're becoming more and more important. And if you remember the first graph I showed you, there's this increasing trend of use of these dark orders. So, correlation and causation are not the same thing, but it makes you wonder, this new group of traders have come into the market and darkness is also rising in the market. So could they have anything to contribute to this? So that's, and we know that, from recent papers of my co-author, Hendershot, we know that, high frequency traders supply the majority of liquidity in markets these days. So are they doing that using these hidden orders? So that was the question we had. So, but before we go on to the empirics, we want to see a little bit in whatever theory exists, to see what should we expect a priori, so that it's not a data mining exercise really, but what would theory's guide be to whether it's high frequency traders are using this. So now we don't exactly have consensus on whether high frequency traders are informed or uninformed. So what if they are uninformed? Let's assume that high frequency traders are uninformed. Well, in that case, their exposure risk, which is what the Copeland-Galai paper said and Kumar's paper found, their exposure risk should be low. So they shouldn't be worried about exposure because they send very small order sizes to the market and they almost continuously monitor markets. So if conditions go against their expectation, because of their low latency operations, they are the best place to be able to cancel and reposition their orders. In fact, in the US markets, in many stocks, about 95% of all orders are canceled. So high frequency traders are doing this all the time. So they should have no reason to hide their orders if they're uninformed. What if they're informed? So some recent papers are saying, well, high frequency traders sometimes trade by front running and back running institutional and other informed traders. So maybe their trades carry information very short-lived, because they just got it from others and they jumped in front of others and they need to quickly trade. If that is the case, they shouldn't be using these hidden orders. And the reason being, hidden orders suffer a little bit of a penalty. The fact that you are not willing to display the volume that you want is given a little penalty by the exchanges, and the penalty is that they lose time priority. So very quickly, what is time priority? When all equity markets are organized on a price, time, exposure basis. So if you place an order at a better price, you will jump ahead in the line. That is the first criteria. So even if you came later, you get to go ahead. If two orders came in at the same price, whoever came in earlier, so time is the next determinant. unless two orders come in at the same time, same price, and one is non-displayed. If you check the non-display, you get to the back of the line amongst all the orders which are at the same price. Okay? So you pay a little bit of penalty in terms of the time, right? If you place the order earlier but you said non-display, they still put you in the back of the line. Now, if high frequency traders are trading on very short-lived information, the last thing they want is to be dinged on time because they quickly want to execute. So why would you use a hidden order? So if you look at the theory on order exposure and the organization of markets, you would say that a priori, HFTs should not use hidden orders. Now, what do we do then? We're looking at data from the National Stock Exchange of India because we think this is a very good place where to test whether high-frequency traders are actually using hidden orders. Why is that? Compared to the US markets, Indian markets are less fragmented. Yesha mentioned yesterday that there are 14 registered exchanges and over 40 alternative trading places in the US right now, right? Many of them dark pools. So if you're a trader, high-frequency trader in the US markets, and you don't want anyone to see your order exposure, you have a choice between going to NYSE and checking non-display, or you could move your order off to the dark pool, and we would never know that you were there. What was your choice? In India, there is no such availability. So everybody who's trying to do dark orders will have to use the lit exchanges and use their dark order facility. So it's a great data set, great setting. Co-location in the US does not have any specified date. If you know how co-location happened, different exchanges rented different facilities in Weehawken, New Jersey, and all over Mahwah, and you have to go through press clippings to see who allowed whom to trade through co-located servers and so on. So it's absolutely dissipate. You kind of know high-frequency trading was on the rise. Really? I have 5 minutes left? Darn. Okay, so let me just tell you on the data. The last thing is that this data is detail rich in terms of identifying high frequency versus non-high frequency traders, and we exploit two sort of flags in the data. One is whether traders are using an algorithmic order entry versus not, and the other is, are you trading on a proprietary or your own account? Definition of high frequency traders in the literature is if you use algorithmic order entry but you're a prop trader. So we actually get that classification in the data, and we are using this. Now, our first comprehensive slices and dices of the data set was just to make sure whether HFTs are using this or not, because if we didn't have, okay, sorry. So this is high frequency traders' use of iceberg limit orders, which is what India allows, hiding 90% and exposing 10% of the orders. If you look at number of trades, volume, and a few other things in the paper that you will see, this graph told us that we have a paper. High frequency traders are actually using them, because otherwise, we're just happy we confirm theory, they don't use it, go home. But that's clearly not the case. So they're using these iceberg orders, and if you like a picture better, you kind of see the same thing, that in their displayed orders, they're doing exactly what Kumar's paper showed, but in their high frequency traders non-displayed orders, it's exactly the opposite trend. They are using more towards the best bid and ask. So now the next thing is about this large order sizes placed at the back of the book. What about the order size they're using? So if you look at the non-high frequency traders, indeed their hidden orders are big share sizes shown here. Big share sizes hiding in the back of the book. Look at high frequency traders graph on the other hand. Between 0 and 50 share sizes is most of their hidden orders. So they're using small aggressive orders placed towards the front of the book, very different from what the non-high frequency traders of the olden days were doing. Then we look at how effectively are they using these. And I kind of made some of the slides yesterday, so I apologize for these too many numbers in a table and so on. But here what I want you to see is the execution probability of the iceberg limit orders. High frequency traders are actually getting better execution than the agency traders and the non-algorithmic traders. So they execute their orders more efficiently in terms of, what is the likelihood of getting the order executed and not just sitting in the book and getting canceled at the end of the day. We looked at survival analysis, sort of borrowed from your Low, McKinley, and Zhang model, and we looked at time to completion, and high-frequency traders actually have the lowest time to completion, and all of this is happening because of extremely good order anticipation strategies that they do. We looked at an implementation shortfall, like Perold sort of measure, where we showed that high-frequency traders have a lower implementation shortfall, so they get a higher fill rate. Although their effective costs of executing is higher, their opportunity cost of non-execution, which are the two components of this implementation shortfall, opportunity cost is so low that it actually cancels out, and they have a lower cost of execution. So pretty much things that we think high-frequency traders should do, they are doing it with their hidden orders. A big part of the theory of order exposure related to the information content of these, the traders. What kind of information do they have? So we've done a lot of analysis on the information. I'll present you 3 sets of results. So the first one is this Hasbrook 1991 model, and we find that, of course, trades as expected have, trades have high information, but amongst 3 categories of traders, the high frequency traders have the lowest information content. You look at other measures, Ajay tells me I'm out of time, so basically every way you cut it, impulse response functions, information shares, Hasbrook 1995 model, all of these show that they use iceberg orders with the lowest information content. So we finally end with sort of one possibility of why they use this, and this is for undercutting, like this Michael Lewis sort of situation, where we define an undercutting order as one which goes within 10 milliseconds of a previous order, jumps just 1 tick ahead of it in the same side of the book. And what we find is, indeed, high-frequency traders are using these small, aggressive, dark orders at the front of the book to try and undercut, even when you control for these traditional, hidden volume detection and aggressiveness of order and all of that. Everything that you can throw into the model, you throw it, and you still find that this is undercutting, sort of using them for undercutting. So finally, we kind of say that those of you who are asset pricing theorists in the audience, we kind of say we don't have a theory of why high-frequency traders would use hidden orders, and in that step, we show that undercutting could be one of the reasons. Thank you very much.
Okay. So we don't have a formal discussion for this paper. Shall we do it like this? Pradeep, why don't you run next, and then we'll just do a discussion of both papers put together, because they are related in interesting ways.
Of course, it depends on how you look at it. I'm looking at it as I was there to fill a hole. But yes, it's lovely to be able to have the opportunity to present this paper. This is joint work with Kiran Kumar from IIM Indore, who's here. And it's wonderful that he's here. As soon as there is a question, I can pretend I have a senior moment, and just look at Kiran Kumar to answer all the questions. So that's very convenient. And Ram Tirumalai, who is in Mumbai today, but he is busy with affairs of state, apparently at SEBI. So we don't have the pleasure of having him here. So this paper is about pre-trade opacity, or pre-trade transparency in some form. And pre-trade opacity essentially arises from the restrictions in the ability of market participants to observe all the pre-trade information in the trading process. Now, the hidden orders are not as, if you like, sexy as dark pools. And so I have to rely on dark pools to be able to titillate your interest. For the recent debate on dark pools has focused attention on pre-trade transparency. And SEC has been taking a serious look at regulatory actions that may be warranted to bring light to dark pools. But dark pools and what we are discussing today in this session, both Bidisha's paper and mine, are very different. Dark pools are off-exchange trading locations. They are a segmented market. They are not they are linked, but they are a different market. Now, on the other hand, exchange orders are, on-exchange hidden orders are part of the integral system of the exchange and have become an imperative in all order-driven markets. So in all order-driven markets, you have the ability to display only part of the order. Some exchanges have different rules. These orders, I think Bidisha has already explained, so I will not go into any detail on this. But they automatically execute with the same price priority of the displayed orders, but with losing time priority at the same price. Now, losing of time priority is a serious matter because at every point of time at the same price, you go back to the back of the queue as soon as the displayed part of your order is executed. Then you go back to the back of the queue. If you have displaying, say, 1 share out of 10, after 1 is executed, the remaining 9 go back to the back of the queue. So it's not trivial. The hidden orders, as we know, constitute a very significant depth and volume in order book markets. Something of the order of about 50% of traded volume comes from hidden from liquidity which was hidden, and about 10 to 15% of orders tend to be hidden by orders themselves. So as we know, information-related transparency is very fundamental to the existence of a level playing field across market participants. And from an economic perspective as well, information-related transparency should generate greater confidence to trade and lead to more competitive price formation that arguably reflects better information and arguably brings about a quicker reversal of any deviations from fundamental values. So we want a good information environment, and therefore any kind of restriction of transparency would potentially be deemed to be negative. And we also know that prices are most efficient and informative as when private information gets quickly reflected into prices, and that can happen only through the trades of informed traders. So it is perfectly reasonable for informed traders to be hesitant to expose their information footprint. So as Bidisha had mentioned, the old literature about providing a free option value, that free option value applies to both uninformed and informed traders. In fact, it applies even more to informed traders. So as liquidity suppliers, informed traders may be less willing than uninformed traders to provide free options through their limit prices. They also may not want parasitic traders, and therefore informed traders can arguably prefer a less transparent market center. And if informed traders prefer a less market transparent center among competing centers, then that less transparent market center would arguably have a better price discovery and potentially greater depth. And this was recognized way back in the 90s when there was a lot of this discourse over the battle for order flow between London and Paris. The London dealer market had low transparency, very low transparency, but had many more informed traders and much, much greater depth. The Paris order book market had high transparency, low informed trading content, and low depth. So from that literature, we know that full and complete transparency is not necessarily a policy desirable. And so hidden orders are not necessarily unadulterated bad. They also would be good if they produce a better, a more accurate price formation in the market. Now, transparency in the limit order book is much higher than other markets because you see a two-dimensional price quantity schedule. Given the trade-off between the benefit of transparency and the participation in informed trades, it's no surprise that most order book markets have the ability to post hidden orders. Now, the theoretical models of informed traders and on-exchange hidden liquidity that are most relevant, or probably the only ones that are relevant to informed trading, are Bulatov and George, RFS 2013, and Sophie Moyna's paper, which has a recent version as well. This is a little older reference. Now, the essential idea, there are some other theoretical models, but they assume that informed traders do not supply any liquidity. The old school which said informed traders only take liquidity and uninformed traders supply liquidity. So those are kind of not relevant to this. And there are theory papers, for example, Zoo RFS 2014, that model off-exchange liquidity in dark pools. So that's, again, not really relevant because that's segregated from the exchange, and in fact, a lot of the implications become different between segregated exchanges and the same exchange. Now, Bullet of George is the one which is most relevant. Allow informed traders to coexist as liquidity demanders and providers in a setting which both where traders can hide and display their orders. And their key reasoning is that informed traders want to capture the extra rents from providing liquidity because that's revenue. But if they have to display the liquidity providing orders, they lose some of the informational advantage to uninformed traders, and this causes them to back away from liquidity provision in displayed markets, which weakens the competition among liquidity providers. So the conclusions are that if liquidity can be hidden, informed traders will all choose to be liquidity providers. And uninformed liquidity providers will have to compete with informed liquidity providers on lower rents. They also, their model also brings about the fact that information will be more effectively incorporated into quoted prices. Yes? Okay. So their model will also brings about information more effectively incorporated into prices if you have hidden orders, and therefore pricing errors should decrease, and they also imply that liquidity should improve. Now these are virtually exactly what we test in this paper, and this is virtually exactly what we find in the. Moinas comes about with conclusions that are similar to Bullet and George, and I will leave the others. There's an experimental study which looked at actors, Bloomfield, O'Hare, Bidisha mentioned that, and which finds sort of consistent results which are largely consistent with those of Bullet and George. And given time, I'll not go into it. Now, so on the basis of this theory and experimental evidence, informed traders should dominate in the placement of hidden standing limit orders, and uninformed liquidity traders should dominate the placement of marketable limit orders or orders which execute immediately where liquidity is being demanded, but with no clear implications for the hiding of those orders. So this is the empirical research which nothing has directly addressed this issue, and this is what we do in this paper. Okay. So our primary focus is to examine how the information level of market participants interfaces with their preference to use hidden orders when they supply and demand liquidity. So do informed traders prefer to use hidden orders when they're supplying liquidity by placing limit orders or when they're demanding liquidity through market limit orders? And is the presence of more hidden order submissions and associated trades related to more efficient price discovery and greater liquidity? So that's, and the answers to all these three questions, in case I don't get through the representation, is yes, yes, and yes. So we use, of course, the NSC data, and I don't need to sell it to you. We have also the coded identities of each and every trader, because this is a little old data, it's pre-HFT, so this paper doesn't compete with Bidisha's paper. Bidisha's paper is on HFT contribution. So it relates to that period. Again, I will leave out some of the slides. Let me just say that this is the amount of depth which is contributed by hidden orders. As you can see, the amount of depth that is contributed to hidden orders is about 35% to 40%. It's very high. I will have to choose what I present here. So as you can see, roughly about 15% of the 10 to 15% of the standing limit orders are hidden, and about 5% of the liquidity demanding orders are hidden approximately. In number of trades, the proportion is much greater, and I will have that somewhere. We also divide, since we have the data which is very granular, we divide it into various different ways. And all of the various lead to the same result, but I'm presenting just one. So we divide it into financial institutions, individuals, financial traders, what Bidisha would call 2 minutes, okay? I'll try and look the other way. So let me present it this way. Because we don't have discussants though, yeah. So financial institutions are, yeah, that's right. So financial traders are essentially exchange members who are explicitly liquidity suppliers. So they have mean reverting inventories, they have short horizons, and so we'll identify them looking at their trading pattern. Some of the institutions, for the exchange members, the exchange members, prop traders, yeah. Okay, now we look at the information level, and we measure information level of an order. So this is somewhat different. We do everything. We do both, but it's somewhat different from the information level results presented by Bidisha, which were related to the impact of trades. Now we are looking at the information level contained in orders, which also, and you know, we're not presenting it here, but also look at probability of execution of the orders and so on and so forth, depending on how we slice it. The results are really the same. So the results I'm presenting is now relate to a simple measure of information level, which is that if you are informed, then the price should change the direction of your trade, of your order placement. And if you are informed at a short-lived level, then you will see that in the next 15 minutes. Or if you're involved at a medium-term level, you see it in an hour. If you're informed at a long-term level, you see it in a day and in 5 days. So we look at short-lived information and long-lived information from that perspective based on the order. And we also do that with respect to trades, but that's a different story. And we look at, say, hidden versus non-hidden. So this looks at divides the data by liquidity quintiles. And as you can see, this is least liquid, most liquid. And we compare non-hidden versus hidden. And these are simple descriptors. We don't need complicated analysis for this. And the t-stats are very high with consistently across everywhere. The hidden orders have, if you like, would be deemed to be more informed than the non-hidden orders. We do it with respect to the trading category of each of those various institution categories. Again, hidden versus non-hidden, we get exactly the same results. We do it with type of limit order. Now, surprisingly to us, a large number of marketable limit orders are also hidden. But anyway, we get exactly the same result coming in from them. Now, we also sort of control for investor type and other things and look at the probability of an informed trader submitting a hidden order as distinct from just these descriptive statistics. We find that a one standard deviation increase in financial institution information level increase the likelihood of hiding the order by 2%. Now, we all separately show the financial institutions are the most informed out of all of these categories. Applies to both SLOs, standing limit orders, and marketable limit orders, and buy orders and sell orders. For other traders, the effect is a little smaller, but still in the same direction. Now, we also look at other proxies, profitability proxy, the adverse selection measure, which is used in the literature. We use that as well. We categorize the traders in different ways, something that I'm less comfortable about, but we follow essentially the Kyle paper in that respect, fundamental traders, day traders, and others. And with respect to how we classify, the results are very similar. Then we also look at pricing errors. We also look at Hasbrook information shares and all that. There are so many results, I'm not really presenting them here. We also look at pricing errors. Pricing error, okay, I'm just finish it off. We look at pricing errors. Pricing errors are where we say, okay, let's infer a fundamental value. What is fundamental value? The information efficient price as determined by the fact that an efficient market should reflect all available information and price changes should be random. So we can decompose the price series into an information efficient random walk and an add-on on what we call a pricing error. I've used that in a JFE paper of mine. There's been used earlier on in 80s as well. So we use that pricing error measure, and we find that okay, where are the results here? Okay, so anyway, let me put out the results since Ajay has given me a deadline anyway. So overall, what I was about to find was trying to find the results of the fact that pricing errors are lower and effective spreads of uninformed traders are also lower when informed traders use more hidden orders. Now, this is exactly what Bulatov and George's model would predict. In addition, we find that traders with longer-lived information are more likely to trade patiently using hidden orders. We find that financial institutions submit hidden orders when informed very clearly, very strongly different. True for both standing limit orders and marketable limit orders, and robust to different measures of information. The other types of investors also tend to use more hidden orders when informed, though the evidence is weaker for the other investors. So overall, we are working on polishing up the nuances and so on and so forth, and doing some other stuff. But the message is that hidden orders are very relevant for informed traders. Informed traders tend to use them in a much more aggressive way.
Thank you.
Have I left out something, Kiran?
Thank you. So we have 15 minutes for some discussion. Kumar, we hope you'll also be part of this. I want to kick off by just thinking a little about what is going on here and how to better understand and interpret the result. I want to locate this in history. Before algorithmic trading came along, electronic exchanges had hidden orders. It used to be called DQ, disclosed quantity. Okay? So this has been around for a long time. Now, the early use of DQ was basically entirely institutional. So an institution wanted to do a 10,000 shares order, he would disclose 100. Okay? And every time the 100 was filled, the next 100 would be shown, and it made logical and intuitive sense that you would lose time priority because your next 100 came late. So your incentive to show 10,000 was that you got time priority. You could elicit other people to hit a 10,000 order, but that was your call. If you felt secrecy was better, then you would use a DQ. Okay? Now that was the old world, that was the old trade-off. It seems to me that
it was also a way for institutions who needed, so for instance, if I'm an asset manager and I had a simple redemption or inflow coming in, there was no information to it other than investors putting more money into a fund, and therefore they had to go out and get the stocks, and therefore
so
there wasn't
I'm
real
not saying there's one
given.
answer. I'm saying that was a choice given to an institutional investor in the manual trading computerized age.
That's right.
Meaning we were typing in keyboards, but there were no algorithms. Your choice was case one, show an order for 10,000 on the screen, which was probably interesting because you would perhaps elicit other people to put an order. Okay, so think like this was a bulletin board system. The electronic order book was a bulletin board system to elicit other people to take interest in trading. Or you said, no, this is just too lethal. I don't want to disclose that I have a problem, that I'm hungry for liquidity on this. And then I show 100 and behind is a lot more liquidity. And each time the thing refills, you lose time priority. And in that old world, time priority was really not important because trading was not so active. So it felt like a very small price. Okay? That's the environment in which this DQ was invented. And now we are in a completely different world, and some of those old metaphors are being applied. In my conversations with algo traders, it seems to me that there is this surpassing interest in FOK orders, in fill or kill. They're not even thinking DQ anymore. The order type that people want today, that the traders are doing or writing, and what in the literature is often called a fleeting order, is the FOK, it's the fill or kill. That is, I'm going to put 5 shares. They're always doing very tiny quantities. I'm putting in 5 shares. If it goes through right now at this price, great. If not, I just want you to cancel the order. So very often people are sending in an order, and without even knowing the answer of what happens, 1 millisecond later, they're following it up with a cancellation. Okay? What is the logic? What is going on? The problem is that the latency between the exchange and the colo has just become way too long. The latency in India is around a millisecond. A millisecond is way too much time. Too much is changing in the state of the book inside that 1 millisecond. So there's a surpassing fear of failure in order execution. That, remember, there's one loop which is the information flow from the exchange to me. There also there is a delay, which people are generally not counting. In the standard metrics of exchange latency, people are saying, when I send an order, within how much time do I get back an order confirmation from the exchange? Which in an NSE environment is roughly a millisecond. Okay? But there's also one more delay, which is the state of the market, which was prevalent at the time when the information feed came out, landed in my hands with some delay. Then I thought about it, that introduced some delay. Then I sent the order. So the overall delay is probably 2 milliseconds or even more, because sometimes the broadcast systems are particularly inefficient compared to the trading systems. So my understanding is that traders have a surpassing fear that I actually have a wrong picture of what's going on in the book. I actually don't know what's going on. So that fear is driving this extreme caution, which is both pushing down order sizes. Nobody wants to take a risk with doing a bigger order, because if something fumbles, my order execution goes in a wrong direction. Either that I'm putting a market order and I get a surprising price, or I'm stuck and it doesn't get filled with the probability of non-execution. The squishiness of the market, the fear of orders not going through, is what is driving this rush for FOK, that I'm just going to put an order. If it goes through, great. Otherwise, I don't want it to go through. I'll rethink the world a few milliseconds later. And now the interesting question is, what kinds of traders will be more careful about doing these disclosed quantities versus not disclosed quantities? I'm not readily getting the idea that there are two different high frequency traders. They're both lean, mean thinking machines. They're writing very good algorithms. They're being statistical. Largely, this in finance, we would call it uninformed, because they really know nothing fundamentally. But they're really statistical guys. And what shapes the decision of one to give it a little more time and obtain time priority versus sacrifice time priority and get a little more opacity? The option value that you lose for small orders at the touch is negligible. I mean, I just don't see an option value type of story. The other thing that we have to keep in mind is, apart from this HFT, now there is the order execution world. This is the institution who wants to do 100,000 shares. Okay? Those guys are just out and out writing algorithms that will get them the most efficient execution. There are now specialized vendors who are just writing software for institutional execution, and they are accountable. They are held accountable because people are measuring that what was the touch at the time I began at a 100,000 share parcel, in how many minutes did I finish the 100,000 share parcel, and what was the order degradation that I got. So there is extreme accountability for those people, and there is an entire specialized genre. There is a subculture of firms who are only writing good execution algorithms. So now we have to again put ourselves into that maximization, that I know I'm an institution, I know I want to buy 100,000 shares, I know that 100,000 shares is a lot, I know that ordinarily a dumb execution will move the price in an adverse way. Now how do you dribble it out? How do you get the least done? And by the way, I fear that a lot of the apparent informativeness of institutional orders is actually just price pressure, that a 100,000 order, 100,000 share order is dribbled out over 20 minutes or 200 minutes, and it looks like the price went up systematically in the correct direction. What was actually happening is just price pressure. So we need to be careful in some of those interpretations. So I think this is the funny landscape that we are facing, and we need to think more. So I love the fact that both these papers are coming at this NSE microdata and asking deep questions. Are there any other thoughts, questions, comments, disagreements? Yes, please. Could you grab a mic?
So I have, I guess, a comment for both Bidisha and Pradeep's paper. For Bidisha's paper, you pointed out that perhaps we need a new theory on why HFTs are using hidden orders. I think, I'm not sure if you need a new theory. I think all you're finding is that, first of all, that these guys are not informed. So if they're uninformed, then what they care about is exposing their order. And if it is not costly to hide, then they will hide. And I think that's what they're doing. Why would they want to give more information than they need to if it is not going to be very costly? So I didn't catch the whole thing, but it seems to me that you were saying what they predominantly do is they try to undercut by getting some price priority. But if they're getting the price priority, then the loss of time priority is not that significant because they're first in the queue. And so they just hide. I'm not sure, but at least that was my first interpretation of what you were finding. And with respect to Pradeep, I think, in my opinion, the majority of hidden liquidity in the market is coming from people who are uninformed. Informed traders are always a very small percentage of the overall pool. Maureen O'Hara and others have estimated the probability of informed trading, and then there's a lot of work, but I can imagine it's more than 8% or 5% of the overall order flow. So the majority of hidden orders are from uninformed players. That's my view. And so the question then is, in terms of your design, unless you have a event or some sort of a way to specifically identify informed trading, it's very difficult for me to very broadly classify financial institutions as informed or uninformed. It just seems to me that you need an event study set up where informed traders are suddenly active because news is coming out 2 hours from now, and so they have 2 hours to take advantage of that information. And so the order flow then has the ability to pick up this incremental informed presence, and then any change in disclosure, order exposure, can be attributed more clearly to informed trading. But otherwise, I think the majority of hidden orders are being used by people who just are uninformed. That's just sort of the way I look at
Yesha?
the market.
So, based on Ajay's comments and also Kumar's, I mean, Bidisha, your paper was awesome. So, a couple of questions that I had, based on what Kumar said and also Ajay, is in what respect exchanges are actually enabling HFTs to actually take advantage of hidden orders, or otherwise to evade time price priority. One particular controversy that we've seen in the States is with respect to the use of very complex order types, such as hide not slide or ISO sweep orders that basically provide a way around time price priority and otherwise allow for some camouflaging of orders that one can argue whether or not it's evading time price priority directly or otherwise in that fashion. And I guess what would be interesting from a sort of standpoint of normative, the sort of normative perspective in your paper is whether or not this is good or bad for market quality. I think there's a